Welcome to the Wealth Exec. Let's reach your goals together. I'm Carrie Amaro, and the Wealth Exec is a new venture for me. I was trying to find an outlet where I can use my 15 plus years of experience as a controller CFO to a grander scale to help as many people as possible. I do hope that you're enjoying the 12 Business Days to a New Year series, where my goal is to provide a 3 to 5 minute podcast and free resources. Now, to get the most out of the podcast, feel free to send over questions and topics you want me to hit in the next 10 days. Now, let's get right into the nitty-gritty of today's podcast, which is how financial statements work and some key ratios. If you recall from yesterday's podcast, we touched upon the year-end close preparation, and you also received notes along with the check sheet in the emailed PDF. The next steps, once you have decided where everything goes in your financial statements, is to now understand how are the financial statements related, how are they created, and what are the ratios that best support you. One thing I must preface is you should really review what your industry standards are for the size of your business. What are creditors and investors looking to see? What are your competitors doing? You should try to compare yourself to the industry. There are 4 main financial statements, but for today's lesson, we will be discussing the ones always used, which are the balance sheet, the income statement, and the statement of cash flows. Once again, this is going to be a very top level podcast because we only have about 3 minutes left. So let the fun begin. One thing that you should know is when you're looking at your balance sheet, your assets should equal your liabilities plus your equity. Okay, and your income statements, net income, your profit number feeds into your retained earnings, which is seated in your equity section. Your statement of cash flows, ending balance, feeds into your balance sheet's cash column. Now, there's a few things that investors look at. There's a few things that you should look at. There's a few things that banks look at. Working capital, aka liquidity. Liquidity measures a company's financial health and operational efficiencies. And that ratio is, one of the ratios actually is current ratio, which is current assets over current liabilities. That your current ratio does not fall less than 1 because it shows that you don't have enough assets to cover your liabilities. Positive working capital, on the other hand, identifies the company as having enough funds to run its business. A high working capital isn't always good. It might indicate that a business has too much inventory or not investing their cash properly. Note, a quick ratio is a little different. It subtracts the inventory from the current assets formula that we just discussed above. This better reflects how well cash covers current debt. This leads into our next item, which is inventory turnover. Inventory turnover tells how many times a company sells and replaces its stock during a specific period. That ratio is net sales over average inventory at the sale price. The next ratio that you can look at is accounts receivable turnover, which identifies how effective your collection process is. That ratio is net credit sales over average accounts receivable. Things to note: a high number indicates collection is efficient. Yay! A low number indicates probably a poor collection process or bad credit policies, or possibly you need to look at what type of relationships and credit terms you're giving. The next one is AP turnover ratio, which quantifies the rate the company pays off suppliers during a specific period of time. The more times, the better. Okay, and that ratio is total supplies purchases over beginning AP plus ending AP divided by 2. Now let's get into debt service coverage ratios. Simply put, do you have enough cash to cover your debt obligations? That's net operating income to debt service. Remember, operating income does not include the impacts of interest and taxes. Total debt service includes all debt obligations due within 1 year. including interest, principal, and lease payments. The next important number that we look at is EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. It measures a company's overall financial performance. If you have a lot of capital expenditures, however, this might be a bit misleading. So once again, you kind of need to understand what's going on in your respective company. Well, this brings us to the end of our session. So I hope that it was informative. Please remember to download the PDF. Wherever you find the link, please feel free to download. A few general notes. Please make sure that in addition to you understanding that you're making money or that your ratios look decent, make sure you get a general understanding of your industry. Get a sense of the risk tolerance level for investors and the banks that you are intending to possibly ask for a loan or a line of credit to do a capex funding or to just get you over those troubling times. If you would like me to answer any other questions or topics, please feel free to send your emails to support@thewealthexec.com or message me, DM me, however it's easiest for you to communicate. And remember, let's reach your goals together. This is The Wealth Exec. Till next time, take care.